Good evening. In the heart of Florida, a state synonymous with sunshine and booming growth, a worrying trend has emerged. Over the past several months, specifically since the late summer of 2025, home prices in major metropolitan areas like Cape Coral and parts of the Panhandle have seen a sharp and unexpected drop. This sudden chill in what was a red-hot market has sent a ripple of anxiety through communities and across the country. Homeowners are watching their equity seemingly evaporate. Potential buyers are frozen, wondering if they should wait. To understand the full picture, we must look at the hard numbers. According to the latest reports from the Florida Realtors Association, published in early December 2025, several key indicators point to a significant market shift. In specific zip codes within Cape Coral, Northport, median home prices have fallen by approximately 9% since their peak in June 2025. While not a crash, this is the most significant and sustained drop we've seen in over a decade. It's accompanied by a dramatic slowdown in sales activity. The number of closed sales for single-family homes in these areas was down 22% in November 2025 versus the same month last year. This drop tells a story of waning demand. Fewer people are buying homes. At the same time, active listings are climbing steadily. Inventory has swelled by over 30% year over year in these bellwether markets. Classic supply and demand. When sellers far outpace willing buyers, sellers must compete harder for attention. That competition drives price reductions. Homes that sparked bidding wars a year ago are now sitting for an average of 65 days, up from just 15 days during the 2024 peak frenzy. A buyer at $450,000 in early 2025 may see similar homes now near $410,000. The slowdown is a convergence of forces. The primary driver is the sharp increase in interest rates. The Federal Reserve has raised its benchmark rate multiple times over the past 18 months. 30-year fixed mortgage rates moved from historic lows near 3% to around 7.5%. A $400,000 mortgage jumped from about $1,686 to $2,797. That's over $1,100 more each month, pricing many buyers out. Families who qualified 2 years ago may no longer qualify or are unwilling to take on the payment. Demand has fallen off a cliff. Meanwhile, supply is increasing. Builders are delivering homes started during the boom. More options mean more negotiating power, naturally pushing prices down. Investors, large and small, were a major force, nearly 30% of purchases in some markets in 2022. With financing costs up and weakness showing, many are heading for the exits to lock gains or avoid losses. That investor sell-off adds a wave of supply, accelerating the decline. Finally, homeowners insurance has become a major burden. Premiums have in some cases tripled or quadrupled in a few years. For some, insurance now approaches the cost of property taxes. This non-negotiable expense deters buyers and strains owners. Combine soaring insurance with high mortgage rates and taxes, the total cost of home ownership becomes untenable for more people, further dampening demand. Declines concentrate in fastest appreciating markets. Areas like Miami-Dade and Palm Beach mostly flatten or dip slightly. That geographic variation suggests a localized correction, not a statewide collapse. While serious, today's market differs fundamentally from 2008. Back then, toxic lending and risky adjustable-rate mortgages were time bombs. Today, Dodd-Frank and stricter underwriting require verified ability to repay. New originations carry higher credit scores and more fixed-rate loans. Most owners have substantial equity, giving incentive to keep paying. Banks are better capitalized with stricter capital requirements. Systemic stability helps prevent a housing correction from becoming a financial crisis. Still, short-term risks are real. Prices could fall further if rates stay high or the economy tips into recession. Job losses would be a game changer, no matter loan quality or equity. High rates create a lock-in effect, reducing both buyers and sellers. The market can grow stagnant and illiquid, prolonging price discovery. But long-term drivers of Florida demand persist. Warm climate, no state income tax, business-friendly environment, population growth supports housing demand, even through corrections. We're transitioning from speculation-fueled surges to a more balanced market. Expect slower growth in line with inflation and wage gains. Buyers gain time and leverage, sellers need realistic pricing. Normalization can be bumpy, yet necessary. Navigate with a clear head and a solid plan. In a shifting market, panic is your worst enemy. Clear, practical steps are your best defense. Let's break down what this means for you. Buyers, don't try to time the absolute bottom. Focus on your financial reality. Buy when you can comfortably afford the total monthly cost, including taxes and insurance. Make sure you have stable income and a healthy emergency fund. A 5% dip matters little if you plan to stay 10 years. Sellers, pricing is paramount. Use recent comps, not last year's highs. Invest in presentation. Be patient. Be ready to negotiate. Investors, avoid over-leverage. Stress test cash flow and maintain reserves. Corrections create opportunities for well-capitalized long-term cash flow buyers. Renters, near-term rent pressure is possible. Budget and watch for more inventory. Regardless of plans, keep your credit strong and build savings. What can we conclude? The rapid fall in certain cities is serious and has real consequences. Based on today's data, this is a sharp, necessary market correction, not a repeat of 2008. The key pillars of that crisis are largely absent. This downturn is driven by borrowing costs, freezing affordability. Look past alarming headlines. Seek credible, data-driven sources. The path forward will be uneven. Watch jobs. Without broad job losses, a foreclosure crisis is unlikely. Don't decide from fear. Control your budget, savings, and long-term plan. Stay informed, remain calm, and protect your future.